And have a listen to this. Have a listen to this.
Interest rates are higher. I know people don't like that, but you should be welcoming a stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the workers.
The United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real-life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How you going?
Going good, Thomas. We have a winner. Ooh. I believe we have a winner in the hat competition, the much talked about. I think it broke the internet, as they say. Everyone's talking about who can guess all the names of the people in the intro. And to be honest, in keeping with the shambolic nature of said competition, where people had the chance to win one of my old hats, we've had multiple entries this week, I'm pleased to report. But I don't think anyone got them exactly correct. But here's the thing, is that I went back to find the first voice. If you just heard the intro, you would have heard the first voice that says, have a listen to this, have a listen to this. And I went back to confirm who it was. And because that was one of the ones from the original intro that we did pre the refresh, right? I can't find it anymore. So I think it was actually Paul Keating. I'm like 99% sure it was Paul Keating. But we had a couple of correct entries if you omit that one because they both didn't say Paul Keating. So shout out to Daniel who came in first. Daniel in South Dakota, USA though, which unfortunately, Daniel, I'm going to need you to get to my place to pick it up because I can't afford shipping to the United States. Daniel from South Dakota, he's went with Scott Morrison with the have a listen to this, which I'm like 100% sure it's not Scott Morrison. But then Alan came in, from somewhere in the galaxy. No, sorry, he said sent from my galaxy, the bottom. He said it was Peter Costello, which then I was like, ooh, right era. So probably it could have been, it's more likely that than Scott Morrison, that's for sure. But I can still mostly, probably 70% say it's not Peter Costello. Anyway, we're getting way out of it. So I think we have to award the hat here to Alan, but shout outs and much respect to Daniel from South Dakota, USA. In fact, shout out to everyone listening stateside. Thank you so much for tuning in. For those of you playing at home, it was in fact Paul Keating. Have a listen to this. Philip Lowe, who said interest rates are higher and you're just going to have to get used to it.
You should be happy that the economy is stronger.
Yeah, I don't listen to it. Homer Simpson, capitalism. Janet Yellen, who said it was the US that always pays its bills. Tyrion Lannister, of course, said a Lannister always pays his debts. There was always a clue in that one. And finally, it was Christine Lagarde, who said, don't let the bastards get you. So thank you for playing along. Daniel, if you do want a hat, I've got lots of hats. I've got more hats than Scott Morrison. I'm sure we can find something for you if you can just flick us a note and we'll see what we can work out. So thank you all for playing. I think I'm kind of glad that competition's over. Hey, if you're listening to the show and you haven't subscribed to the show, make sure you do that. In fact, while you're listening, why not? That way you'll never miss an episode. You'll be sure to get it when it's fresh. But Thomas, we've got a massive show coming up. The banks, we're back in the zoo again, of course. The banks are finding out their buffers weren't big enough. Does that mean just no more Netflix for them or problems for you? One of our listeners sent through a cracking plan to tackle rising interest rates. We'll hear from old Thomas Nostradamus as to why it won't work. We've analysed the best vessel to hold drinks in. The results are in and we can't keep it bottled up any longer. I bet you can not wait to find out. But first, we've got Wendy, self-confessed Kmart tragic and unapologetic consumer, up against Tony, high-flying CEO and business boss. Thomas, it's all about mindset. Who's more confident at the moment, consumers or business?
Oh, it's so unnecessarily contrived.
Sorry. Even as I was writing it, I was like, this is dumb. It's a little peek behind the curtain. Thomas gives me a few topics that we're going to cover off each week, and I'm like, yep. And this one was titled Consumer versus Business Confidence. So I just characterised it a little bit, gave it a bit of zing.
Zing, yeah.
Because if I just said, all right, Thomas, let's talk about consumer versus business confidence, people would tune out straight away. They'd turn off.
No, it's fascinating.
Now they want to find out who's going to win the fight, Wendy or Tony.
Yeah. So, I mean, interesting week of data for the
they're turning off already. I set them up and you bring out interesting week of data.
Okay, so Tony had a big week this week.
Yes.
Yeah, he is pumped. Tony is pumped.
All right.
Tony, you know what happened to Tony actually?
Let's start with Tony.
Had his biggest rebound in January in his confidence levels as measured by the Roy Morgan Business Confidence Index.
Is that right?
Yeah, Tony had his biggest January rebound on record. Mm-hmm. Jumped up 10.4%.
Wow.
He's very optimistic about economic conditions and profitability. He then went over to the NABS business survey and also rebounded there, jumped up. And we're now back at boom time conditions based on NABS business survey. Tony's looking as good as he's ever looked, really, apart from the immediate rebound out of COVID, which Tony, as you remember, did very well.
He was flying.
He's flying. We've come off a little from where we were at the end of the year, but we're still pumping along. Trading and profitability are back to boom levels. Forward orders are very strong. Employment is coming off a little bit, but doesn't
this fly in the face of all the other rhetoric that we've been hearing, though, about interest rates going up and layoffs happening in the States? And it just seems like, I don't know, I don't understand there seems like a disconnect there between why Tony and the business community are so happy.
Well, yeah, I mean, this is right. It is a little. It's interesting, and as you're saying that she's not loving it.
Not happy.
Yeah,
not happy, Wendy.
Yeah, no. So the ANZ Roy Morgan Consumer Confidence Index fell last week to its lowest level since April 2020.
Yeah.
So you remember, cast your mind back to April 2020, we all thought we were going to die. Wendy's back there.
Oh, no.
In terms of her confidence levels.
Okay.
Yeah.
What I don't get is why is Tony so happy if Wendy's so miserable? Like, doesn't Tony need Wendy? Maybe we should drop this laboured analogy. I'm not sure if it's helping, but
no, I mean, it's right. Like you can't think that this can continue. I mean, it does seem like some of the rebound in the NAB survey was driven by the China reopening story. So a lot of it was the resources sector was pretty big, so that seemed to drive some of it. But even with that, things are still pretty robust and pretty happy. I think, but basically the economy is still quite strong. Unemployment's very low. Growth is kind of kicking along for now. Business conditions aren't bad, and businesses aren't feeling the glums. You cast over to the consumers. Consumers have just been belted with rate hikes, and that's why they're pretty devo. And that's really what they're responding to. They like rate hikes as much as plagues, apparently.
As pandemics.
Yeah.
Right.
So that's.
But rate hikes hit business too, don't they? Like, or not as much?
Not as much, you would think. Yeah, I wouldn't think so. I mean, I don't really know how to compare those two exactly, but I wouldn't have thought so. I would, because I mean it's different households, so it's really hard to compare. But for the
Tony and Wendy's house.
Yeah. No, yeah. So but I mean, for your representative household, mortgage repayments are a big chunk of the weekly budget. Capital costs are not. I don't have hard data on that, but I imagine are a much smaller percentage of expenses for a business. So I don't know, but I mean they're seeing that in the forward orders. The forward orders is interesting, so that's holding up. So like it's not that they've got a good vibe about the future. They're seeing it right now in their order flow, and they're doing pretty well. But we will start to see the customers the businesses like the B2C, the business to consumers, they're going to have to see some sort of pullback. We saw that we got some reporting season. So JB Hi-Fi, I think last week, saying that they're noticing customers are being more cautious than they were this time last year. January sales grew just 2.5%. JB Hi-Fi in January were flat at the Good Guys. Yeah, so we will see those consumers. I think particularly consumer discretionary. Like you look at essentials, like grocery prices are up 10%. So you've got rate hikes rising. You've got the essential prices rising. Both of those are eating into what would normally go to discretionary consumer spending, which is where that's your JB Hi-Fi. Businesses in that space are gonna have to see some softness going forward. You can't have consumers being that pessimistic and that not having an impact on consumer discretionary. I just can't see that happening. For the rest of the economy, business is still looking pretty. They're pretty happy.
All right, Tom. So apparently half of all loans have breached their buffers. What are we talking about with buffers?
Yeah, so we got an update from Westpac last week. I don't know if you've heard of Westpac. They're a fintech specialising in vintage banking services. Yeah. They had this interesting stat that half of their loan book, almost half, 45%, is at the point of breaching their buffers. So when banks assess a serviceability for a mortgage, they put a buffer. There's a buffer there. So they take the current interest rates that they're offering and then they add a buffer, which was about 3%.
Yep.
So, if interest rates were 2%, they're assessing you at 5% and they're looking at your finances and your bank statements and going, can you afford a mortgage at 5%?
Right.
So that's the buffer. It was quite interesting because we used to have, before COVID, we had a 2% buffer, but we also had a 7% floor. So it was whichever was greater, the banks had to assess you at. So it was either current rates plus 2% or it was a 7% floor.
Right. So you always had to be able to afford a 7% mortgage regardless of what the rate was?
At least, yeah.
Okay.
Yep. But then when COVID came, they did away with the minimum floor. And it kind of made sense at the time because interest rates were at 2%. So you're effectively making the buffer 5%, which seemed, potentially unnecessary. But in hindsight, maybe not such a great move. They scrapped the 7% floor and then just had a 2.5% buffer and then increased that to a 3% buffer. So that's what we've got now. And that's what the banks are looking at when they're doing your serviceability. But the thing is, we've just had over 300 basis points of interest rate hikes. So we've now had, for some borrowers who were assessed at around 2%, because that's what the market rate was back in 2019 and 2020. Post-COVID, it was around 2%. So plus 3% gives you 5%. But we've just had that 3% given to us from the RBA. So we're now blowing through that buffer. So what you've got now is you've got borrowers who could afford 5% when they got their loan in 2021 are now looking at an interest rate that's higher than what they were assessed on.
Yeah, right. Because the banks were like, there's no way it's going to go up 3% anytime soon.
Yeah.
And Phil Lowe was all, hold my beer. and then whack, and here we are. But this is a result of the fastest kind of rate rise or rate, whatever you call it in economic terms, in history, isn't it? So now we've breached the hold. We've breached our buffers.
Yeah, that's right. So to guess what ANZ's Shane Elliott was saying, that the lowest rate they ever gave anyone was 1.94%.
Right.
On a fixed rate. We assumed rates would go up to 5.25. We're about where we're at that now. So we're at a very difficult pivot point going forward. So if rates keep going up, we're now looking at, that's more than what some borrowers were assessed on.
Right.
But what I found really interesting was that it's for Westpac, it's 45% of their loan book.
Yeah, wow.
So I would imagine, Westpac, big name, there's a lot of people, I would imagine there's quite a few people the majority with Westpac have had their mortgage for 5, 10, 15 years or something.
Yeah. But
45% had it between 2020 and now.
Oh, so is that what they're saying? Like it's 45% of their, what? So 45% of their loan book they took on in the last 2 years?
Yeah, that's right, since COVID.
Wow.
Well,
That's
so
huge.
yeah, between August 2019 and June 2002, so 2022. So yeah,
Right.
a bit about that.
So
Yeah.
this is Westpac the only one? I mean, this should be kind of reflective across the board, right?
I would expect so. I haven't seen this stat reflected for the other banks. We haven't heard from all of them yet, I don't think. But yeah.
Yeah, right.
I would imagine that's representative. And it probably talks to a bit of churn in the mortgage market. So people shopping around, moving rates.
Well, I'm
more.
doing that right now. I've started having another look at lenders because I think that it's competitive as well. Like some of them are offering deals and cashback and Qantas are giving you 100,000 points and all sorts of things to factor in.
Yeah, I refinanced the other day. Got $3,000 cash back.
Did you?
Yeah.
Oh, good on you. Paying 7% though.
I mean, it's interesting, and I think it's interesting because, the question is the quality of the loan book, and this is what blew up in the GFC, global financial crisis in America, is that people realised that the loan book for the big banks was rubbish, and it had all these dodgy, bad debts on their hands.
It doesn't mean though necessarily that people are in mortgage stress yet. It's just that it's just like it's all numbers on a page at the moment, potentially, where they say, well, we assessed them at this much and we gave them a loan. We had a buffer of this much. Just because it's now beyond that buffer, it doesn't necessarily mean they can't make their repayments.
No, that's right. And there are options. There's always options that the banks can do. Like you can move on to interest only if you're on a principal and interest mortgage, for example, and you can take a bit of a breather and just hang out on interest only, or you can extend the loan term, and that reduces your weekly payments. So there's still options. We're definitely not in danger territory here yet, and they're definitely but the banks are provisioning more against bad debts, so that's starting to happen. And if it goes on for a long time, then it might become a problem. But But I just thought it was just really interesting that it's that much of the loan book is that recent. So it does mean what happens in the here and now can have a big impact on a big bank like Westpac potentially.
Yeah, right. Another option, of course, is you could join the class action against Philip Lowe for false advertising when he said interest rates wouldn't rise before 2024. That's another way. Maybe you could talk to your bank about pausing your repayments pending an outcome of this class action for which you've joined the Facebook group.
Yeah.
People against people for Philip Lowe or whatever it is. I heard he's retiring at the end of the year. Oh.
Yeah, his term's up. I think he's done his full stint.
It's going to be a sad day.
Years.
We've had lots of fun with Phil.
Yeah.
All right, let's take a break here. We'll be back with more Comedian versus Economist right after this. Welcome back. You're on Comedian versus Economist. And if you're enjoying the show and you like what we're doing here and across Equity Mates Media, then we would love it if you took some time to fill out the Equity Mates Community Survey. Really helps us understand what you enjoy, what you don't enjoy, helps us kind of tailor some of the content that we do on this show and right across Equity Mates Media. Get on to equitymates.com. You'll find a link to the survey there. You can go into the draw for a chance to win $500 as well as tickets to FinFest happening again this year. So head over to equitymates.com for all of the details. Thomas, we got a really interesting email this week from Zane, and Zane sent us an email, cve@equitymates.com. And I'm going to read the whole email because I'm not sure I'm going to do it justice if I don't. I heard an interesting idea this week that I wanted an economist to help explain why it wouldn't work. And it's one of those things that just sounds like a good idea. If the reasoning behind interest rate rises is the blunt hammer to slow people's spending because borrowed money is expensive, would it be better for the people out here who have borrowed to buy homes if there was a way the Reserve Bank could make the repayments increase the same as they would if the interest rates rose, but that amount was paid off the principal of the loans? This has two positive effects. The borrowers still feel the same effect with higher payments required out of their pocket. And two, the longer it goes on, the healthier the bank's loan book looks because their LVR ratios all improve. So he's saying interest rate increases means the banks make more, repayments increases, borrowers get safer over time. Sounds great. What's the reasoning why this would never work? So my understanding is essentially what he's saying is we're going to raise rates, or the rate of repayment that people have to come up with, but not actually raise the rate underneath. So they just have to pay more, which curbs spending, but in the same way that raising rates would, but without the penalty, like without being punished. And so you actually end up paying a lot more off your loan, you pay it off quicker. So is that kind of the idea?
I think so.
Have I summarise that well?
No, but
No.
but it was the ballpark. It was pretty good. Yeah, no, I think that's it. I haven't heard this idea before, but it's an interesting one. Could it work? There's two parts to that. Like, is it possible? And I think the short answer to that is everything in economics is possible. Everything in the economy is a construct. We've just made it up. There's no natural laws. We can really do whatever we want.
Yep.
So the really question is, do we want to do it? Every choice has consequences. So do we want to deal with those consequences?
Like choosing to record a podcast with the door open means you have geckos, for example. These are some of the consequences that we live with.
No, all the windows are shut. It's just got really noisy geckos. Intense.
Right. Yeah. Okay. So it's all made up.
Yeah. So you could do it. And I could imagine there is some mechanism. It would probably go through APRA. That means there's some kind of special levy that needs to be paid and gets, can go up and down or can become negative, positive, and it's, they could use that as a lever. I could imagine something like that. And on the face of it, I think it could work because we are trying to slow consumer spending. Aren't
we just trying to then control? Like my problem with this argument, with this model, is that I don't want to be told what to do with my money. Like, you're kind of saying, well, you're forcing the repayments to go up. Like, you're just making it feel painful without it actually being painful. But then I'm just like, well, then don't do it. Like, I don't want the pain. I feel like that's like I guess it's a bit like super. You have to pay super. Yeah,
that's right. I mean, you don't feel about interest rates going up. Interest rates are going up right now, and it's just like, wow, this is just money out of my account just because someone's decided.
Yeah, but I'm on Team Phil, and I believe in his vision to curb inflation. No, I guess that's right. I don't really understand. Maybe it's not. Maybe it's the wrong approach. As you say, it's all made up. Like, he's just making up, or the RBA is just making up interest rates. They're making them go higher, just cost. Well, with a plan, obviously.
It's interesting. Like, the reason why we have interest rates is because it affects everyone, and there's sort of a fairness dimension to it to some extent. That, if we raise interest rates, that increases home loan rates, so that affects households. But business capital costs go up as well, so they're sharing some of the burden. They're slowing some of their activity, and really, like the official cash rate, which is what the RBA sets, that's really a benchmark rate for every interest rate through the economy. And the reason why we had such an epic share price boom coming out of COVID when interest rates hit the floor is because the cost of capital all through the system fell to effectively zero, or close to it. And so it's not just like we focus a lot on households because, we get the idea of a mortgage holder and everyone either has a mortgage or knows someone who has a mortgage. And so it makes good front page news, but it's not, we're not specifically trying to target mortgage holders, explicitly. That's not the goal, to sort of punish mortgage holders. And it would be a bit weird to sort of single out mortgage holders. Really what you're doing is saying, okay, we're just going to increase the cost of capital for the entire economy, and mortgage holders are just one group that's going to feel that impact.
But but they're the group that feels it probably more than most, like.
Yeah.
Probably you can't write off your losses. As a household, you go, some bad debts this year. We'll just write those off. What? No, you can't have my house. we're still running an operation here. This is where we run swimming and netball and all sorts from. This is central operations.
Yeah, I mean, there is an interesting point in the sense of like, you work the interest rate lever, you get a big impact out of mortgage holders because it's a big chunk of their weekly budgets, and so it does have a big effect on spending. But that's not true for wealthy households. For wealthy households, their mortgage repayments tend to be a very small proportion of their budget, and when interest rates go up, it doesn't have a big impact on their consumption. Because they have quite low marginal propensities to consume, because they're quite wealthy and they just buy what they want. And if there's more money left over, then they just invest it. It's, like a very broad brush picture. In a way, the sort of the weird thing about interest rates and using interest rates as a lever is the people who are most responsive to interest rates are lower income people.
Right.
Because they really feel it. It cuts back on their spending. It wipes out their discretionary spending, and then, worst case scenario, gets into their essentials. They cut back on essentials. That's not happening for higher income people. And so they're kind of at the extreme. Wealthier people are sort of immune to interest rates. All that changes is the course of their investments and their wealth creation. It's not changing their day-to-day spending. And so if we're trying to cut back slow spending, then we're really putting all of that burden on lower income people. And we're asking them to shoulder that burden. And when rates go down, it's sort of the other story. We're trying to, juice spending, and people, lower income people, have a higher propensity to consume when they get more disposable income. But we're really trying to steer the entire economy on a rudder built out of poor people, effectively. That's a bit weird.
So what's the alternative then? If the interest rates is a pretty terrible lever, as you just described, what's the alternatives?
I don't know that there is. And the inequality dimension to it is that one of the benefits of being wealthy is that you don't care what the government does. You don't care what happens to interest rates. It's not going to break you. What happens with tax rates doesn't have a huge impact on you. You get to live the life you want, and it sort of changes how much is left over at the end of the day, but it doesn't really impact your day-to-day decisions. You're not thinking about it. And so it's the unfortunate situation that anything that's going to cause wealthy people to change their behaviour, their spending behaviour, is going to wipe out poor people. Like, it's anything that big is going to have an intense impact on poorer people.
But couldn't we just tax rich people? Like, could
in theory.
Yeah.
But like, again, like, what are you going to do? Like, they're not going to really, you increase their income tax rate 5 basis points or something. It's not going to have a big impact on their spending decisions, because it doesn't, not enough to sort of shift the whole trajectory of the economy.
But if you tax them enough, like, everyone's got a threshold. Like,
sure, yeah, yeah. We could set up
60% marginal tax rate if you earn,
Yeah,
I don't know.
Move Phil Lowe over to the ATO, and you're just like monthly board meetings at the ATO. Oh yeah, marginal tax rate's going up to 55% this month.
Yeah,
inflation's getting out of hand.
There must be something we can do to curb spending of wealthy households. Surely, we lock them up. You're only allowed out on Tuesdays and Thursdays. If you earn over $300,000 a year and your number plate ends in an even number, you can go shopping on Wednesdays. Like, we curbed water usage when we had the droughts. Everyone bought in.
Yeah, look, all things are possible in economics.
Yeah.
Maybe something a bit Stalinist like that might fly. I wouldn't I'm not imagining we're going to see
Well,
something
the trouble
like
is you
that
got
in our
online
lifetime.
shopping now. You can't. Locking
Those
people up doesn't.
rich people have found a way again.
With their internet, they've probably got like the top plan. They're getting 256 meg download. They're spending faster than their page will render. Who do we go to? Was there a section of the economic community where we go to for answers, or is it all just?
No, that's not something we really do.
No, we don't. I'll have a think about it. I'll ask around. We'll crunch some numbers for you. I tell you what, we'll crunch some numbers and find out if we've got any answers.
Yeah. I can't really think of something where you don't lean on poorer people. And it's just simply because poorer people are more responsive to broad policy things. So unless you specifically go out and slash the tyres of BMWs or something like.
Not financial advice.
Yeah. Well, no, let us know if you've got any ideas about how we can shift the trajectory of the economy without leaning heavily on poorer people. I'd love to hear it.
Or slashing the tyres of the rich. All right, Thomas, to finish off this week, finally, we've got some good news. What is it?
Oh, we love an Aussie battler here at Comedian versus Economist.
We sure do.
Yeah, so some good news story for Aurora, which O-R-O-R-A, Aussie company listed on the ASX. Shares pumped last week, up 14.5% on Wednesday, I think it was, and then closed the week about 20% higher.
Right.
So, yeah, pumping along. They reported their results, announced the 8% increase in net profit after tax. The 6 months ended December 31. The other big thing is they announced that in the last 3 years they've added 200 customers. Oh, I didn't say. I should say.
They must have some sweet margins. Because I'm conscious we haven't told people what they do yet.
Yeah.
So they've just got this company and they've added 200 customers. That's a stall at the markets. What does Aurora do?
They make beads and dream catchers.
Healing crystals.
No, yeah, they're a beer can maker. Wine bottle, alcoholic bottles, beer cans, that kind of business.
Still, 200 customers is not a lot.
No, but I think they're big volumes. It's.
So they sell to 4X or someone.
Something like that. Yeah,
other breweries or whatever it is.
Yeah, something like that. So I think 200 customers is quite a big deal. Yeah. So they've been pumping along. Their volumes are up 10% over the 6 months to December.
So they sell.
Well, yeah, they just make the cans and the bottles for.
This doesn't seem like a new idea. this peckish, cheeky young startup came along and said, "You know what? We're going to make cans and bottles and we're going to put drinks in them." What?
Yeah. But no. What they've
you mean
been pumping?
No more drinking sacks?
That's right. Get rid of your deer gullet. I've got a cannon.
Put down your mead. Right.
Yeah. No, but what they're saying is that they got ahead of the curve with small cans. So there's been a big shift towards 250 ml cans, particularly for soft drinks, but also for seltzers, pre-mixed spirits, and craft beers are even going in the smaller.
I've noticed that. I've noticed that
cans.
The beer can has got smaller. I thought it was just shrinkflation. I thought it was the packets of chips when they went from 50 grams to 45 to 40 or whatever, and we all just had to cop it because of inflation. So I didn't realise that. What is there another reason that small cans are good?
Well, this is how it got reported in the AFR. I think it's saying it's that. Yeah, these small cans are lighter and more convenient for millennials in Generation Z. So I just feel it's like...
Well, they don't want to lift heavy cans.
Yeah. Soft. Millennials, are
Man, this is a result
mils.
of 24/7 gyms. People are going to the gym more. Like back in my day, the only bicep curls you did was with a heavy can. Couldn't get to the gym at night time. You sat around and drank.
But I reckon this is like, like with the tiny home movement in quotation marks.
Yeah.
Like they said, like, oh, yeah, millennials just prefer the minimalist lifestyle. It's like, no, they're living in caravans because the housing market has so fundamentally failed them that they can't afford homes.
Right. Yeah.
And so I kind of feel like, is this just us going like, oh, yeah, millennials prefer less beer to more. And we're giving it to them.
Because the 6-pack has shrunk as well. It's no longer a 6-pack. It's a 4-pack now.
Oh, right.
It's a 4-pack of small cans. Before you know it, we're just going to get a carton that's going to have one beer in it. We'll be like, oh, this is what it is now.
Yeah, so I reckon it is a bit of shrinkflation. I reckon it's firms getting away with offering a bit more.
I also heard that they like the ability to decorate a can. It's far like there's a shift towards cans over bottles too. So not only are we sort of shrinking, we're not just shrinking cans, we're getting rid of bottles, moving away from bottles. Is that right?
Yeah. Well, I don't know about that on a whole level, but definitely Aurora is saying that. They're saying like huge demand for cans. It's all about the cans now.
Right.
Yeah.
I don't know. Maybe it's like an Instagram thing. Like the ability to decorate a can is important. Like,
what do you mean? What do you mean decorate a can?
Like put pictures on the can. It's easier to do it on a can than it is to decorate a bottle.
Like when you get home.
When you get home. No, for the people who are making the drinks.
Oh, okay. Yeah, right. Is it? I don't know.
Apparently.
I don't imagine
that's
labels.
What they said.
Yeah, really? Okay. Yeah, there you go.
But I don't know. It was never a consideration for me when I don't drink a lot anymore. But when I used to, it was never a consideration what it looked like. It was very much about what was inside. And I don't know if this is a part of the Instagram generation where, the same reason that we have mirrors in the headphone section at JB Hi-Fi now. Like I never.
Oh, right.
I never worried.
Yeah, right. Wow.
I never worried a great deal about what my headphones looked like.
Wow.
When I was listening to music, I just because I wanted to listen to music.
Yeah, right.
But I guess also we just assumed that headphones looked ridiculous because they did back in the day. Those wide things with the little foam.
No, the other interesting stat I saw here. So Endeavour Group's CEO Steve Donoghue, who Endeavour Group do Dan Murphy's and BWS, they're saying their fastest growing product is the Suntory 196, a pre-mixed spirit made from vodka, soda, lemon, and a fermented liquor called shochu.
Yeah, good. That's good. People are worried about ChatGPT and it's going to take all these jobs. I don't even know what a drink is anymore. Like there's shochu, kombucha, seltzer. People are drinking seltzer. I think I'm now feeling old. I'm officially feeling old.
Yeah.
Because I don't know what Suntory 196 is.
No. I mean, vodka and liquor. Oh, it sounds terrible. Tune in next week for more old men complaining about booze.
All right, let's leave it there. Thank you so much for tuning in. We'd love it if you left us a rating and a review wherever you get the podcast. Also, don't forget about the Equity Mates survey. It's your chance to have your opinion on what we do here and right across Equity Mates Media. Thank you once again, tuning in, and we look forward to talking to you again next time. Bye for now.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.